Hello, and welcome to this webinar on small business tax liability reduction strategies. I'm your moderator, Jenny Alton from the New York Small Business Development Center Central Office. This webinar is brought to you by the PACE SBDC, a regional center of the NYSBDC. The NYSBDC is a U.S. Small Business Administration resource partner with regional centers at higher education institutions and outreach offices at other locations across New York State. Our free advising, education, research, and advocacy services are made possible by funding from the SBA, New York State, and our host campuses. For this webinar, we are very pleased to be working in partnership with the New York State Society of CPAs. And as a representative of the New York State Society of CPAs, we have with us today Orumé Hayes, CPA, CGMA, MST, founder and CEO of Hayes CPA LLC. So you know, we are recording today. We will share links to a PDF copy of the slides and the recording in a follow-up email. Attendees are muted and will not be on camera. Your chats will only be visible to me and our presenters. If you have any questions during the presentation, please don't hesitate to type them in the Q&A box as they come up. You can open Zoom's Q&A box from the Q&A button at the bottom of your Zoom window. And we may take a few questions during the presentation, and ones that we don't take during the presentation, we'll try and catch at the end of the presentation in an open Q&A session. So with that, I will now turn the time over to my colleague, Greg Callender, from the PACE SBDC.
Thank you, Jenny, and good afternoon, everybody. I'm Greg Callender, a business advisor with the Pace University Small Business Development Center. At the PACE SBDC, the focus of the services we provide, all totally free of charge, are aimed at helping existing New York small businesses as well as aspiring entrepreneurs who are looking to start a business. Some of the services we provide include helping entrepreneurs to obtain financing, assisting with comprehensive business plans and financial projections, developing social media and marketing strategies, applying for MWBE certification, and gathering market research. PACE SBDC services are one-on-one, offered in person or via Zoom, and we also offer services in both English and in Spanish. In a few moments, I will place into the chat a couple of links. One is to the main PACE SBDC website, and the second link is one that will allow you to register for free business assistance. In addition to the free one-on-one business advisory services that we also offer a variety of training and educational programming. Today's event is an example of that. We have been fortunate to have members of the New York Society of CPAs volunteer to share their expertise with business owners on a variety of small business accounting and tax matters. As tax reduction strategies are an ever-evolving issue of great interest to small business owners, this afternoon, Ms. Orumé Hayes will be providing us with the latest intelligence on this very important subject. And with that, I will turn it over with our thanks to Ms. Hayes.
Well, thank you very much, Craig and Jenny. Thanks to both of you for that warm welcome. I appreciate it. And want to make sure that am I on mute? Yes, you guys can hear me, right? Because I think Greg is on the screen. Okay, great. All right, so thank you for that warm welcome. Let me go ahead and share my screen so that we can get started. And great, you can see my screen now. Give me a yes or a thumbs up if you can see my screen.
We can.
I think you can. Well, welcome everybody. So today we're talking about small strategies that small businesses, tax strategies, small business strategies that what you can use to mitigate your tax liability and things that you should know as a small business owner. This is a really very important topic. As a small business owner myself, this is something that's near and dear to me. So anytime I get an opportunity to speak about this, I love to do that. So a little bit about me. As I said, I'm the founder and CEO of Hayes CPA. I am a director at large with the New York State Society of CPAs that where the PACE SBDC is partnering with on this seminar. I serve in a lot of different capacities. I love this profession, accounting profession. So I serve at the federal level with the AICPA. I chair a committee there. And I also volunteer with a lot of other associations like NABA Inc., where I am a regional vice president. Another thing that I love to do is teach. I am also an adjunct lecturer of accounting at the College of Staten Island. And then I offer graduate advising services at Hunter College, another CUNY college. My small business, I've been a small business owner for 8 years. I've had my CPA license for over 20 years. So I do know a little bit of what I'm speaking about here, so to say. If we were doing this in person, I would ask you guys to introduce yourselves so that you get to know each other. If you guys don't mind sharing, you can type it in the chat box. Tell me where you're logging in from today. What stage are you in your business, and what do you hope to gain from this seminar? I know you won't be able to reach each other's comments, but I will share it with everybody at large as I can see those comments coming. Let me open up my chat. I can save my chat in a minute. I see a lot of comments coming. Okay, from Rochester. Rochester is in the house. Brooklyn, New York City formation stage. There's someone coming in from Niagara County. Thank you for being here. Delaware County, from Long Island. Thank you. Thank you all for sharing. Startup phase. You are in the right place. You're in the startup phase. You want to learn more about business. Coming in from Brooklyn, you want to learn from a CPA. Wow, a lot of folks. There's somebody else coming in from Queens. So thank you all for sharing that. You guys are in the right place. So that's what we're going to talk about today. All of what you are talking about. And Greg just put some links in the chat box. So make sure you click on those links and save them, because those are tools and resources that are available to you guys. And I've leveraged all the small business resources myself when I was starting up my practice, and they're really good, informative information. So this is what we're going to do today. We're going to talk about how you can understand and manage cash flow. Cash flow is king, right? Without cash, it's really difficult to run a business. We'll talk about owner's compensation, because people are working, they always want to know, how do I get paid? What's going on? How do I get paid? So we'll talk about that. We'll talk about the different ownership tax structures as well as business structures. Then we'll look at what we call cash versus accrual accounting, the tax filing requirement. And then one of the fastest way to mitigate your tax consequences is by utilizing depreciation. We'll also talk about that. There are my social media handles. If you want to follow me on social media or tweet while we're discussing, feel free to do that. Tax strategies at my CPA accounting on Twitter, X, and then Instagram is Hayes CPA. I'm also available on LinkedIn. So let's start with cash flow, because cash is something that all businesses are always concerned about, right? Cash is king, like they say. Cash, that's the most liquid asset that you will ever have. Without cash, you cannot do anything, right? You need cash. If you have any employees, you need cash to pay your employees. You need cash to run your business, period. If you're buying supplies, if you have a computer, if you have to pay for your telephone bill, your electricity, whatever it is, whatever business you are in, whether it's a commodity-based business, you're selling merchandise, or you're in a restaurant, cafe business, or you're providing a service, you are going to have expenses that you need to pay with what? Cash. Nobody's going to accept anything else from you. Sometimes some businesses might give you credit, but otherwise the most liquid thing that you need, the most liquid assets you have in your business is cash. So that comes in different forms, and all businesses want to have that. So when we look at cash, it's the amount of cash you have coming in. How do you get cash in the door? Your own investment in the business. You're getting cash from maybe you might have some folks who invested in you, maybe family members, and then you might also get cash from a bank. And then the most important source of cash is from your customers, from your clients. We're in the business, if you are running a for-profit business, you're in the business to make money, right? And your cash is going to come in from your clients. So that is your inflow, your your cash inflow. This is going to help you to be able to pay your bills. And then that's the outflow. Once you start paying your bills, once you start hiring employees, contractors, you are paying those bills. You need to be able to pay your bills to keep your business afloat. The one thing I always hear, why do small businesses, why do they go out of business after a couple of years? The most common reason of failure is cash. They basically run out of cash. And that's because businesses don't do the planning that they need to do. So we'll take a look at the cash flow statement. You need to be able to analyze how to read a cash flow statement and do projections so that you know that you're pretty much running your business properly. So like I said, you're looking at cash, right? Cash is coming in, cash is going out. So you want to be able to understand this. These are some of the main sources of inflow, which I spoke about previously. If you have accounts receivable, that's not good for a small business owner. Accounts receivable is that you're selling your services or goods on credit. We are not a bank. You don't want to be having accounts receivable. When you get paid, you want to collect, if you are in a service type of business, you want to get a retainer on file from your clients. Let them pay you a deposit immediately. If you complete that work, they pay you the balance. You don't want to have accounts receivable. And if you do have accounts receivable, you want to make sure that you are collecting frequently, every 30 days. You tell them 30 days is off, you can give them a 30-day extension. But do not float your customers' receipts, your customers' services for 60 days or 90 days, right? Like I said, you can also get cash inflow from loans and then equity investments. If you want to have a partner in your business, you can get equity. You give out some percentage of shares of your business, and then there could be an equity owner. The outflows of your business, your operating expenses, if you have a physical location, you have rent, you have to pay for supplies, you have to pay for tools, all of those things, those are outflows. Accounts payable. Yes, while we do not want to have accounts receivable, if you have accounts payable, you can use that to leverage your cash outflow, right? But again, you want to be mindful to make sure that you yourself, you're also paying your bills on time. You don't want to get into the place where you are always late on your bills and nobody's going to want to do business with you, right? Just like you wouldn't want to do business with another business that's always late on their bills. You don't want to be the business that's always late on their bills. So you want to make sure that you're managing your accounts payable properly. And then if you have a loan, you want to make sure that you're planning for your loan payments, you're managing this properly as well. And then equity owner. If you have an investor in your business, how do the investors get rewarded? They're in the business, not just because they want to help you out. Yes, they want to help you out, but guess what? They actually want a return on their investment. So you want to make sure that the business is profitable so you can give that investor dividends and they can get paid as well. That's why they're investing in you and investing in your business. All right, hope you can see it. I know there's a lot of numbers and figures on here. I'm going to walk you through an example of what we're looking at. Let me make sure I have my laser. So at the top is, so let's say this is a new business, right? You need to be able to interpret a report like this. I know businesses, whatever your business is, you're in business to do whatever it is you're doing. Maybe you're a painter, you're an artist, you have a barber shop, you have a physical therapy shop. You want to do what it is that you do. You don't want to be concerned with numbers. But guess what? If you're able to read statements like this really helps you plan better for your business so that one day you don't wake up and then you see that sign that we all see sometimes when we walk down the streets, we'll see that sign going out of business. We don't want that to happen to you. We want you to plan properly so that you don't run into a cash crunch at the wrong time. So let's say for this small business, this is a projection, a monthly cash flow for 3 months. It's a projection for January, February, and March. So you see there, the business, they started the month with $18,000 in the bank. So then you have the cash inflow. They sold and collected cash of $40,000. They had receivables, things that they sold in the month before, let's say in December or prior. and then they collected $12,000 from their customers who previously had debt with them. And then they knew that needed some money. They took out financing. They got loan of $10,000. So their total cash inflow for that month was $62,000. Then what did they spend money on? You look at their outflows. They spend money altogether. This operating expenses covers everything they're doing to run their business. They spent a total of $45,000 in operations, and then they paid their bills, some other bills that they owed. They paid $5,000. So their total outflow was $50,000. And let me say, so their monthly balance is $12,000. How do we get to that $12,000? That's the inflow of $62,000 minus the outflow of $50,000. That brought in $12,000. The cumulative balance, which would be the balance they had at the beginning of the month, $18,000, plus the difference of what they actually brought in that month, they had a balance of $30,000. So guess what? They start the next month, February, with $30,000 in the bank. So they go through the process of collecting money that month. They collected $45,000 in the second month. And how much did they spend? Look at what happened in the second month. For whatever reason, they had a lot of operating expenses. So they spent $70,000 the next month. And so they were basically in the hole. They spent more cash than they actually brought in. So they were in the hole $25,000. Goodness, how are they going to pay for their bills in that month? Well, they had $30,000 at the beginning of the month. So now at the end of the month, they now have $5,000. You go on to the next month, the third month, they're starting with $5,000 in the bank. They go through the process in the month. They're projecting $35,000 collections, cash inflow, and then they're projecting $45,000 of cash outflow. So that means what? They're going to have a negative balance of $10,000 in the third month. So what should they do? This tells you now, when they look at the amount of money they had at the beginning of the year, which was $5,000, and they're expected to be negative $10,000 in that month, this tells them that they need to go and borrow at least $5,000 in order for them to be operating in the next month. So this is why you do planning in advance. You project your cash, your monthly cash flow. You do that projection 6 months or 12 months in advance. Make it as realistic as you can so that you are not running day to day and living paycheck to, like some individuals live paycheck to paycheck. You do not want that for your business. You want to have projections so that you can know and you can manage what's going on with your cash. Okay, so this is the cash flow statement. At the end of the year, then you prepare something like this. So for this business, this was their cash flow statement at the end of the year. So I want to go over this with you because this will give you a different insight as to why sometimes you hear businesses say that, hey, but my business made a lot of money. How come I don't have any money in the bank, right? So you see here, it says the cash at the beginning of the year. This was a 2021 report. They had $18,000 in the bank. And then we do this cash flow report. The cash flow report is in 3 sections. You have your operating activities section. That means everything that you're doing that has to do with your business. The middle portion has to do with what you're investing in your business. The third portion has to do with what you're financing in your business. So when we look at everything that so for the operating section, we always start with our net income. Where do we get our net income from? We get that from our income statement. So you look at what the income statement said. This income statement said that this business made $25,000, almost $26,000 that year. You go through all of the operating activity items, and you see that the net operating income for the year, they were actually negative. They were negative $30,000 in change. So that tells you that even though on paper, on the income and income statement, it showed that the business was profitable with $26,000. This cash flow report says that we were not profitable. Our operations, we were at a negative of $30,000. So how did you run your business then? We wonder. We look at the other section, the operating section. They paid for some investments. Maybe you bought some computers, or you bought a new vehicle. It's a transportation business. You bought a new vehicle. So that's an outflow. When you see a negative, that's an outflow. So you purchased a vehicle, you paid money for it, you got money, they paid $16,000. So that's a $16,000 investment in their business. Then we look at the financing portion. That's the third section. You see that they paid back $20,000 of money that they borrowed, and then they borrowed from another bank another $10,000. So they had financing a net effect of $10,000 outflow. Then you look at the bottom line is that what do they have? They have a net decrease in their cash of $56,000. At the end of the year, they have a deficit of $38,000. So then businesses will ask, I have a lot of business owners that come to me and say, why does my profits report, why does my income statement say that I have income, but I don't have anything in the bank? I'm negative. Where did all the money go? That's because of stuff like this. You need to know how to interpret the data, how to interpret the numbers of what's going on in your business. You don't have any money because you invested in a vehicle, you invested in some supplies, you invested in some big ticket items. Those things were expensive. You had to pay for some operating expenses. Those things were expensive. They use cash. You borrow money to pay your bills. That's why you don't have money in the business. So you have this understanding and you do this projection, then you know what's going on. If there are any questions that you guys want me to answer while I'm doing this, feel free to jump in. So we're going to, because we're going to switch topics. Is there anything you want me to address there before I switch topic to the next topic?
Yes, we do have a couple of questions. So the first is that financial template that you were just showing. Is that available anywhere?
So I will have the handouts. The handouts will be available to all of you. I don't have a blank template, but it's very easy for you to replicate what you find on the handout. If you know anyone that knows how to use Excel, you can pretty much replicate it and generate your own templates in Excel. And if you don't, if you need further help, feel free to reach out to me offline, and I will I'll work with you to create one for you for your business.
Thank you.
All right, great. Thank you.
Next question is, this person runs an independent consultancy for professional services. How would they properly categorize the payment that they make for themselves in the financials at the end of each month? And I guess it's from the business bank account.
Okay, so that's actually that is a very good question. That ties into this next section that we're going to, which is owners of compensation. So depends on the type. It depends on the type of business that you're running. If you're running a sole proprietorship, basically the net income, the very bottom line, that's your money. That is because it's you and your business. Even if you have an EIN, you're running it as a sole proprietorship, it's reported on your individual tax return. So that's your compensation for the year, so to say. But sometimes, depending if you set up salary, you can actually have owner's compensation as a line item to show that you're taking out salary. So let's talk about owner's compensation. Salary, that is something that's that typically is received every month as an employee if you are an employee of a business. But so paying yourself sometimes is not ideal. But I feel if you start running a business, most of the time, most business owners are just putting labor and sweat and everything into their business, and they're not taking any money out. But really, you actually do want to pay. You would like to. You should get compensated for your time, because if you were working for somebody else, you would be getting compensated, right? So that is one way that you can compensate yourself. Another way you can compensate yourself is to take out a bonus or a commission. You land a big client, similar to how you would hire somebody and you would pay them a bonus for landing a big client. You know, if you want to give yourself a salary, you want to take a look at if you were hiring somebody else to do the work that you're doing, how much would you be paying them? Is this role worth $40,000, $50,000, $100,000? And that's the first question. Then the second question is, can your business afford to pay you that salary? So, if the business can afford to pay you 50 grand, great. If they can afford to pay you 100 grand, and that is a reasonable salary for the job for the role that you're fulfilling in your company, then you can do that. Or you could go with a low salary, let's say of 50,000, and then the business gets a big contract towards the end of the year, and it was all because of you. Guess what? You can bump up your salary. not necessarily bump up your salary, but you can give yourself a bonus. So that's another way that you can get compensated through your company. You can do employee reimbursement, right? So if you have to do a lot of travel on behalf of your business, have the business reimburse you for those business expenses. They have to be, so that travel has to be in relation to the business. That you can, just similar to how you would reimburse an employee if they were going out to see a client on behalf of yourself, of your company, you would reimburse them for that expense. You can reimburse yourself for those expenses as well. And sometimes, depending on if you can get a good insurance policy, you can offer for some other fringe benefits, medical benefits, insurance, healthcare insurance. That you can offer. So how do you take money? You can take money out as a draw. You can take out a dividend, right? And I'll explain this more as we talk about the type of different tax structures. Or you could give stock options, right? If you don't have the funds, sometimes how do you get partners to work with you? You come across this really, really talented person, you want them to be part of your business, but you don't have the funds, the cash to pay them. What do? You can offer stock options, give them equity in your company. So that's a way that you can compensate a co-owner, a new owner that's coming in. And then also retirements, offer retirements, contributions. There are a bunch of different retirement plans, and we'll talk about this before as we go through the seminar. So let's move on to the next topic. So let's talk about the different structures. When we look at the first one, which is the sole proprietorship, that is where you have, you started to operate your business. You don't have a legal structure. It's just you, yourself, and you, right? Me, myself, and I. You get up one day, you're operating an Airbnb out of your home, or you're operating you have a gig as a gig economy worker, right? You may be you're driving an Uber or Lyft or Grubhub. You're doing some kind of gig activity. You don't have a registered business. So guess what? That is what is called the sole proprietorship, right? So for that ownership, you basically, if you take money out of the business to spend on personal expenses, that's your compensation. So anytime that you're not different, you're not a different entity from your business, because it's sort of like an informal business. That's why sometimes the IRS, you have to go through a bunch of different rules to make sure that you qualify to fit the mold of to be recognized as a business, as a trade or a business. And we want to make sure that you're not really just operating a hobby, something that you just enjoy doing and you just want to be able to take some write-off. So this is the easiest, the most flexible type of compensation structure and business structure. So that's the sole proprietorship. If you make money, the net earnings of your business, that all belongs to you. You get to take that money out, spend it as you will, but you pay taxes on it on your individual tax return. Then the next structure, which is a partnership. So that is when you have at least two people involved in the business. So here you get to have whatever structure you and your partner agree on. You could decide that you guys are equal partners. It could be a 50-50 split in the profits or loss. So somebody could be putting in a little bit more services or a little bit more capital, and you could decide that the structure is 60-40 or 70-30, whatever it is, you want to agree to it, and that is what you are going to abide by. So your compensation in the partnership, that is reported on a K1. The partnership itself files a different tax return, and it gives you what we call a K1, similar to how, if you guys remember when you were employees, you would get a W-2 from your employer. The partnership, that's the business, is going to give you, the partner, the owner or the co-owner, a K1, and that is what you're going to use to report income on your personal tax return, and that's what you pay tax on. And so your compensation as a partner is going to be based on your partnership agreements that you have with your partner. Then we get to the third structure, which is the S corporation, rather. The S corporation, for the S corporation, we always want to make sure that you take what we call a reasonable compensation. There are lots of business. Sometimes you might, I don't know if any of you have seen on social media where you see a lot of people giving tax advice and business advice on social media. You can listen to some of them. It's a lot of fun and games, but you want to be mindful of some of that advice because it can land you in trouble with the IRS sometimes. But with S corporation, people talk about the S corporation. You can get a lot of savings from the S corporation. Yes, that's true, but there's a but. The but is how profitable is your business. When you start a business, for the most part, most new businesses are going to be running at a deficit. That means they're going to be running at a loss for the first couple of years because they're trying to get their name out the door. They're trying to get their business up to speed. So they might be running at a loss. If you're running at a loss, it doesn't make sense for you to be structured as an S corporation. Why is that so? Because the S corporation, it has a lot of compliance that comes with it. And with that compliance comes some additional expense. So you're going to have additional expense to register the company and also to pay your CPA or your tax preparer to fulfill all your S corporation requirements. You have to set up an actual payroll, have an actual payroll account for the company, and the owner has to take out what we call reasonable compensation. Why is this so? Because the IRS doesn't want you to just take money out of an S corporation, which is easy to do. They don't want you to take money out of the corporation and not pay taxes. They want you to be able to pay into your Social Security. Let me just go back a minute. As a sole proprietorship, you're paying two levels of taxes. You're paying taxes for yourself as the business owner, and you're paying taxes for yourself as the employee. So that's why we call it kind of two levels of taxes. Whereas if you were an employee, you would only be paying Social Security as an employee. So since you're paying two levels of tax as a sole proprietor, the employer side and the employee side, because you're self-employed, when you are an S corporation, you can avoid one of it, because if you pay yourself as an employee, the business can deduct the employee's portion as a business expense. That's where we call it a tax savings. Because you can save on payroll taxes as an S corporation, most people want to go for this business structure, the S corporation business structure. But it only makes sense if the business is having a minimum of about $100,000 or maybe $75,000, because you want to make sure that it's worth your while. So if your business is running at a loss, if the net profit is $50,000, it might not be the right time for you to be a S corporation. The good thing though is that you can always change structures. You can always convert. It's a paperwork that your accountant will have to file for you, that your CPA will file for you every 3 months. Up to March 15th every year, you can do what we call make an S election. You can file paperwork that says, hey, Mr. IRS, I used to be a corporation, or I used to be an LLC. Now I want to convert to an S corporation so I can take advantage of this tax strategy. But wait until your business is really profitable before you do that, okay? And then for the last one is the corporation. The corporation, which is really a C corporation, the C corporation is subject to two levels of taxes. You can take a regular salary from the business, and that's going to be deducted. And then the other way you get paid from the business is to get a dividend. And when you get a dividend, when the corporation pays you, the owner, a dividend, that dividend is also subject to tax on your individual tax return. So that's why we say that the corporations are subject to two levels of taxes. So you want to be mindful of all of these things. Which one should you do? Like I said, the sole proprietor, it's easy to form. It's very easy. It's flexible. But you are responsible for your self-employment taxes. You have to make quarterly tax payments because nobody is making those payments on your behalf. And if you don't make those payments and you owe a lot of taxes at the end of tax filing, at the end of the year, you're going to owe some interest and penalties to the IRS. So you want to be mindful of that. For the partnership, you can have a limited liability structure. The best thing about a partnership is it can give you that liability. It protects you, your business from your personal assets, so that so in your business, you have limited liabilities. They cannot come against after you personally. The manage, it's easy to transfer, bring in a new partner. If your existing partner doesn't want to be involved any longer, it's very easy for you to transfer ownership for the partnership. Again, you are filing, even though the partnership is filing a separate tax return, you get a K1 that you have to file with your individual tax return. And then for this S corporation, it's not as easy. You do have limited liability. So again, the owners are protected from the business so that their personal assets are protected. You can hire separate management to run the business if you don't want to be involved in it, or you can run it yourself. And then the S corporation itself does not pay taxes. The S corporation files a tax return, you get a K1, and then if the K1, if your business made a profit and your share of that profit will be reported on the K1, and that's what you file your taxes on. And then, like I said, the C corporation, you want to be a C corporation. This is a structure where there's a lot of compliance that goes into it. You want to think carefully first. Do you want to be a C corporation? Usually, if you think that you're going to want to go public, and you want to have a lot of investors, this is where you're looking at a C corporation. Otherwise, it's really a very complex tax business entity structure, and not one that might not be the best structure for you to start with. But like I said, you can start with any business structure, sit down with an advisor to find out what it is that you want to be doing, where you're going to be operating, where should you register, and then you can decide what structure you want to register, you want to work with. And then, like I said, you can always change by March 15th of every year to a S corporation. But you can only do that once every 5 years. It's not as if you can be changing your business structure every year. Okay. There's some things called the 20% QBI deduction. This is a deduction. I'll talk about this on the back end, a deduction, an additional tax break that small businesses can get. So anything on that before I move on to the next section? Any question? There's some things on there.
We have a lot of questions. So
okay, let me take one before I go on to the next section. Go ahead.
Okay. All right. We'll get through these as speedy quick as we can. So before you had shown that cash flow statement, what does it mean for taxes if a business is in the negative at the end of year, like you had the example? Sure.
So if you're in a negative, that means number one, you don't owe taxes. So then the question is going to be, so you still have to file your tax return. But the benefits might be that if you were actively involved in a business, and let's say it's a Schedule C and you're actively involved in that business, and then let's say you still have a W-2 source income, you still a W-2 source job. If you have that W-2 income, the loss from your business, you'll be able to offset that against your W-2 income. It's not every time that where your business has a loss that you'll be able to offset it. There are certain laws. We have to look at the rules to see if you qualify. There's something called passive activity versus active activity. If you're a passive investor, like for example, in real estate, if the real estate is, if you have rental property and that's operating at a loss, you're not able to offset all of your real estate losses against your other income because it's called a passive activity. The loss is going to be limited. So it can have some beneficial tax results if you're operating at a loss. But the other thing you also want to keep in mind is that you do not want to be operating at a loss every single year, because after a while, like I said, the IRS could state that, hey, is this a hobby or is this a business? Why is this, if you're in business to make money, right? Why is it that every year over year, you're running at a loss?
Okay, thank you. What would you recommend for a CEO of a business to figure out how much to pay themselves?
So there are compensation studies out there. So what I would suggest is that you go into any of these platforms, let's say Indeed or any of those job posts, right? You put in the title, you put in the search as if you are looking to apply for a similar role, and go to and see what other businesses, comparable businesses, are offering somebody in that position. So like I said, it has to be, you cannot, if the position is worth 100,000, you cannot arbitrarily say, hey, I want to be paid 500,000. That's an amount that could be challenged by the IRS if it's not reasonable. That's why we talk about reasonable compensation. It needs to be what a normal business will pay for that role.
Thank you.
Okay.
And one of our attendees just reminded me that the Department of Labor has salary statistics as well. So
Right. Yep, you can find a lot of salary statistics. There are lots of publishers. A lot of employment agencies also publish salary. I know Robert have they publish a salary survey as well. So you can find that information in a lot of places. All right. So shall we move on?
sure, I'll catch more of these later. So go ahead.
Okay, great. So when we talk about accrual accounting, this is required by accrual is required by GAAP. Accrual is required by GAAP. It's required by the accounting standard boards, right? So GAAP is what we talk when we talk about accrual accounting. We're talking about running your business using some accounting terminology, what we call GAAP, generally accepted accounting principles. This is the principle that you should use to run your business. You should use to record your books if you're running if you want to maintain your books and records according to proper accounting. That's what we call accrual. So when you use accrual to record your accounting, you're going to determine your revenue and your expenses when you perform the revenue. So let's say you have a car wash, right? You perform the service, you are going to record a car wash. Actually, that's not a good example because they usually run as a cash business. So let's say engineering or architecture, they do the work, right? Once you do the work, you're going to recognize revenue. However, you might not collect from the client until maybe 3 months down the line, or 2 or 3 months or 4 months, whatever, sometime in the future. So that's going to be in the future. But because you're recognizing revenue, as soon as you finish the work, you've performed your service, you're recognizing revenue. As soon as you consume your expenses, you go and purchase supplies, you pay your laborers, you pay your employees, you pay for your utility. When you have spent and you've used up those expenses, you're going to record those expenses on your books, regardless of the fact that you have not paid those bills, right? So that's why those businesses have accounts payable. You're going to pay that bill, that light bill, that electric bill, you're going to pay it in the future. But guess what? You can record that expense on your income statement, on your financial statement. So you're recognizing expenses when you use them. So you will usually have accounts payable. You have accounts receivable, that's your clients owe you money. You have accounts payable, you're going to pay your bills in the future, even though you've used those expenses right now. Those businesses that have accrual, they have what? They have, they can run into bad debts. This is when you've done the work for your clients. After a while, you've been sending them bills, collection notices, and after a while, they don't pay you, and you hear that they're going out of business. That's where you have bad debt. So if you look at the other side to bad debt, you can see for a cash type of business, you have no bad debt. Why is this so? Because for the cash, you're recognizing income only when you actually get physical cash from your clients. You're not booking revenue on your books if you have not yet gotten the cash from your clients, whether it's physical cash, whether it's them sending you a check, whether it's them paying by credit card. If you receive payment from your clients, then you recognize income. If you have not yet recognized, if your client has not yet paid you, you do not recognize income on your books. And same thing with payments, with expenses. Once you paid for that expense, then you're going to record it as an expense on your books. So typically, if you're operating using the cash method, you have no accounts receivable, you have no collections. You don't have to worry about collections because everybody's coming to everyone is paying you in cash, right? The example I always like to give is like, you don't go to a restaurant, have a great meal and say, hey, hold on guys, I'm going to pay your restaurant bill in a month when I get some money. That doesn't happen, right? So so you have no accounts receivable, you have no bad debt. So since you have no accounts receivable, you don't get to say, hey, I have some bad debt that I want to write off. Sometimes I get some clients, some small business clients that say, hey, I have bad debt I need to write off. And I have to ask, how do you operate your books? Are you operating by accrual on an accrual accounting basis or cash basis? If you're using cash basis, you really don't have any bad debt. If you had generated an invoice, technically, basically, all you need to do is void that invoice. Void that invoice because you never yet you're not utilizing accounts payable for you didn't have any accounts receivable. Okay, because so the main thing is that using cash method, it's simple, whereas accrual is a little bit more convoluted, it's more complex. There are things like deferrals, and I don't want to go into accounting speak. I don't want you guys sleeping, or closing your eyes on me. But most small businesses will run their businesses through recording on using cash. So whether you're using a computer program, whether it's QuickBooks Online, whether it's Xero, Wave, or anything of that nature, it's easier and simpler for small businesses to maintain their books using the cash method. Accrual method, businesses, like I said, if you're in a public firm, if you're a big company and you just want to run your books, have your books be run properly. If you are a non-for-profit and you are getting grants from the government, you want to run your books, you want to record your books using accrual accounting, because when you have to generate those financial statements, those are some of the things that they look at. So a little bit more complicated, but it makes a difference in what you can do and what you cannot do in the business. Okay, so this is here, what I have for you here is tells you what the tax structure is, what the business tax structure is. So this is the latest tax tables for 2024. So you can see the tax brackets. Right now, our lowest tax bracket is 10% for individuals, and we go up to 37%, right? So if you have 3 columns here, if you're a single filer, if you're filing as married filing jointly, or if you're head of household. If you're married filing separately, that's basically the same thing as a single filer. Okay, so you depending on what you make. So these numbers are after you've taken whatever deductions you are eligible to take. So basically, so let's say if we look at the third bracket, in the 22% bracket, if you made anywhere from, let's say, 44,000 to 95,000, you'll be paying 22% in taxes. And then over 37%, so basically you make over $1 million, over 578%, you'll be paying the highest bracket, which is 37%. And then you look at the bottom here. I'm sorry, the lines are a little bit off, but these are corporate taxes. So you can see for the C corporation, they have a single flat rate, which is 21%. So this is where you want to sit with your accountants to do some tax planning. What kind of business do they have? Do they have a C corporation? Do they want to, and then are they in a high income tax bracket? If they are on their individual, when they file their individual taxes, and they are in a high income tax bracket, then maybe this is where it would make sense for the C corporation to show that if they have more income to show, for you maybe to take less salary, if they have more income to show, then you see that you're paying taxes at the 21% rate instead of a higher income rate. But keep in mind, though, that when you take money out at the C corporation, if you get paid a dividend, that is that double taxation. Then you get to pay, we're not going to go into this today, what we call capital gains. The dividends are going to be taxed at a different tax bracket. And then you can really see carefully because this got messed up, but partnership, S corporations and LLCs, this is what we call to as pass-through entities. So all of these businesses, if you make money, if you have income in either of these business structures, partnership, S corporations or LLC, you're filing a tax return, but you're paying tax at the individual tax rate. So depending on how much the business made, if the business made 200,000 or 300,000, they'll be paying, you'll be paying on your individual tax rates, which will be at 35%. So if you have any questions on this, feel free to check in with me later. So let's get to one of the, and then we'll come, I think we'll have a little bit of time for some questions. We'll get into almost to the end. The depreciation, this is one of the fastest way that small businesses can mitigate their tax liability. Depreciation is not an actual expense. It's not an actual cash expense. You do not pay for depreciation with cash. But what happens is that if you have purchased a big ticket item for your business, let's say you purchase a vehicle, you purchase some machinery, you're manufacturing things and you had to buy some machines to operate your whatever it is you're manufacturing. It's a farm, you purchase some tractors, some of those big tractor trailers or things of that nature. You can see the examples here. You have a laptop, a printer, a monitor. What it is that the item that you purchased, usually if for big ticket items, things that are worth above $2,500, the IRS does not want you to deduct $2,500 on one item as a whole, usually on your tax return. For you to be able to deduct it, we call it depreciation. This is where it's an allocation method. That $2,500 that you spent or that $10,000 that you spent on that item, you're going to allocate it over the lifetime of that property, of that assets that you purchased. Similar to how you say, people tell you, you go to a new car lot, you purchase a vehicle. What do they say? That vehicle is worth less than you paid for it immediately you step out of that lot. It's almost the same thing when we talk about depreciable assets. Those are physical properties. It's not necessarily the wear and tear of the property. It's just that you're saying that this new asset that I purchased, this vehicle that I purchased to use as a delivery truck for my florist shop, it's going to last for 5 years. So you're going to allocate the price of that vehicle over the 5 years that you're going to use it to operate. So here you see this machine that was purchased for, I'm not sure what you purchased it, but the allocation is $480 a year. And basically you're splitting that into 12 months. So the depreciation expense is $40 a year. That's the concept of depreciation. Now, there's some very good things, tax consequences that you can take advantage of. One is the minimum safe harbor election. If the item that you purchase is less than $2,500, you can deduct it, make an election on your tax return and deduct that $2,500 on that new laptop that you bought. You can deduct it in 1 year instead of having to spread it out over 5 years, which is what would be the recommended lifetime of that new computer. So that's if you have the income, if you have income and you can benefit from that deduction, then you should utilize it, take that deduction. So there was something else that we call bonus depreciation. This was a tax law that was passed that allows us to be able to claim. Previously in 2022, we used to be able to claim 100% of that ticket item. So sometimes you see some businesses, they'll purchase equipment worth $500,000, and yes, they would be able to deduct $500,000 from their tax return. That's why sometimes you hear of all of these big businesses, all of those Fortune 500 companies, public companies, whereas they're making a lot of money, but guess what? Every year they're showing a loss. Why? Because they're taking advantage of tax strategies like this. In 2024, what we can do, the most you can deduct on for bonus depreciation is 60%. You can no longer deduct 100% of bonus depreciation. And then there's one more depreciation expense that you can take. This is called Section 179 election. I don't think anybody on this call will want to take that. This is where you can basically deduct $1.2 million. So if you bought a new airplane, a new ship, a new something, and you want to be able to deduct it. Now, the good thing, the thing to also keep in mind is when you're doing this, you want to be making strategies. You want to be mindful. Is your business actually running? Does your business have income to show? So who can benefit from taking a $1.2 million depreciation deduction? If your business reported maybe a net profit of $2 million or $1.5 million, and then you can take a $1.2 million deduction. If your business is operating at a loss, then the deduction isn't going to do you any good. You might as well spread it over the lifetime of the assets. So, because then maybe the depreciation is going to be helpful in the future when your business turns around and you start to make profits. So just because that tax deduction is available to you doesn't mean that you need to take it immediately. So be mindful of that. All right. And the last thing I want to touch on retirement. Actually, that's before we get to the retirement. I spoke briefly about some of the additional deductions that are available to businesses. This is the 20% qualified business deduction. If you are running a business, this was part of the, what year was it? The tax reform that we had previously. It allows us to take, if your business has a profit, we're able to take a 20% deduction. So whether you're operating as a sole proprietorship, a partnership, a S corporation, you can take out 20% deduction. There's some calculations that comes into play. If you are what we call a specialized trade or service, so if you're in a type of business activity that includes health, law, engineer, architecture, accounting, things that they call specialized. You have to have a specialized skill or service. You're a chef, you're a famous chef, you're whatever, that you don't get to take it 20% deduction off, like forever, off your total income. It doesn't mean that if you make $1 million, you can take 20% of that $1 million. The deduction is going to be capped. After a certain amount, you begin to lose the ability to take that depreciation. That's our QBI deduction. So the amounts range roughly around, if you make anything, about $385,000 if you're a single filer. If you go above that threshold, you start to lose the ability to take 20% deduction. It starts to be mitigated, and then after a while you lose it completely. It goes down to zero. So, but the good thing is that most tax preparers, most accountants, everybody really, it's part of what we do. If you qualify for this deduction and your business is profitable, we automatically take that deduction. We calculate that deduction for you. The other thing that I know that small business owners struggle with, or they sometimes talk about is are they operating should they be hiring employees or independent consultants? You want to look at it, because if you are, let me say, I think we're running out of time though, so I'll be very fast. You want to make sure that if you are classifying somebody as an independent contractor because you want to save on employee taxes, you want to make sure that you're following the rules. On the IRS website, there's specific rules as to whether you're controlling that individual who's working for you, whether they're involved in your employee team meetings, whether you are having them sign a timesheet, things of that nature. They're just very specific rules that you need to be mindful of. Yes, you want to save on taxes from your employees, but you want to be mindful of, is this person an employee or is this person really a consultant? Because you will save by working with consultants instead of working with employees. And then additionally, I gave you the latest numbers if you want to contribute to a retirement plan. $7,000 for an individual IRA, a traditional IRA or a Roth IRA. And then you can also set up plans through your business. That's another way that you can save money in the business. Set up a an individual with a retirement plan for your business, and then the business gets to take that deduction. You're saving for the future you, for when you're going to go into retirement. So it really pays. A lot of small business owners don't think about doing this. It really pays for you, if your business is profitable, for you to set up a retirement plan for yourself so that you can take care of your future you. And that brings us to the end of this webinar. I want to thank you guys. I don't know if we have time for a quick question or two, but I'll leave it up to Jenny. Otherwise, I want to say thank you. Go ahead, Jenny.
Yes, we have so many questions.
All right, let's see. I can take a couple before I have to
You could
jump
take a
off.
few. Okay,
Yeah.
all right. So I'll do them in the order that they came in.
Okay.
So just really quickly though, I do want to remind everyone that you will receive the recording, a link to the recording and a link to a PDF of the slides. So you will have this information to review, because I know that was like lightning round, all the things for business taxes. So thank you so much. You'll be able to review. I know we've had a few comments of,
Yes.
wow, we're going to get this recording, right? Yes, rest assured.
Yeah, and I know I speak fast because I'm like looking at the time. I'm like, but a lot to cover. So let's get it all in. So
It's great. Do you mind putting your contact information back up on the screen? We've had some people request
sure.
that. So I'd love
Yes.
to have you share that while we do a couple
Okay.
of questions.
Yes.
Again, so I'm just doing them in order that they came in.
Mm-hmm.
If you are a single member LLC, are you able to have fringe benefits? Is that a possible thing?
Single member, yes. As long as you document it, yes, you can have fringe benefits. You document it, make sure you're tying it to a business reason, right? If you decide that you want to go, your fringe benefit is for you to fly first class to Hawaii. How do you tie that back to your business? There needs to be a business reason to it, so that it can withstand any challenge by the IRS. But yes, you can set up fringe benefits for yourself for your single member LLC.
Excellent. Can an LLC give equity in a business for cash?
Yes, an LLC, it can do that. Basically, when you see, if you guys listen to Shark Tank, it's all business structure. Any business structure, you can give equity. So basically, it means that if you're giving away equity, it means that you're no longer going to be a single owner. So by default, you will now change from being a single member LLC. You're now by default a multi-member LLC, which is by default a partnership. And then you can always elect to become a different structure. But yes, once you're giving away equity, you're basically admitting partners into your business operations.
Right. This is another sole person LLC question. So how would a person set things up so that it's a disregarded entity for taxes? Can they do this when they start?
Yeah, so the default option when you register an LLC with the Secretary of State, or if you have a DBA, it's with the county clerk, I believe. The default when you register an LLC is that you are a disregarded entity. That means that they call it a disregarded entity because the LLC itself is not regarded as a separate entity. You don't file a separate tax return. You file a tax return on the Schedule C as part of your 1040, as part of your individual taxes. If you decide that, hey, I want my LLC to be separate and distinct from me, I want to have a separate tax return, because when I file for an application with the government, or when I file for an application with a loan, I want to be able to give them a business tax return. I don't want to have to give them my business tax return that is intertwined with my individual tax return. I want to be able to give them a business tax return. That's when you make an election that you say, I don't want to be a disregarded entity. I want to be taxed as an S corporation. So that's when you make that switch, or a C corporation as maybe, or something else.
Okay. So checking in time-wise.
Okay. Yes,
You tell me when you want to call it. So
I'll take two more.
two more. All right. The next two questions. This one was a clarification. So sole proprietorship, number or level of taxes, when you were talking about the level of taxes with the different entities, this
Yeah.
person wanted to clarify how many levels of taxes with the sole proprietor.
It always depends with your, it all depends on your, it's the level of taxes dependent on the income level. So I don't know if you can say, let me zoom in here. If you can say it, if your income as a single, let me look at a single filer, right? If you make 11,000 and below, you're in the 10% bracket. If you make under $44,000 as a single filer, you're in the 12% bracket. If you make under 95,000 as a single filer, you're in the 22% bracket. So it depends on the income, on your net income. Of course, nobody wants to be in the highest bracket. Nobody wants to be, we all want to make more money, right? You want to make $1 million, but you don't necessarily want to pay 37%, right? But that's what comes with being in a high tax bracket. That's what they talk about, the 2% or the 3% in America. Those are the high powered, taxpayers or income earners. They suppose that they are in a higher tax bracket, but they pay less taxes than everybody else. Okay.
Right. All right, last question for today.
Sure.
This person is another single member LLC.
Okay.
Can this person make a draw or distribution payment at the year end with a lower tax burden on Schedule C of a 1040 filing without the S Corp election?
Say that again, run that by me
I
again.
know, that was a lot,
Yeah,
right?
yeah,
Okay,
yeah.
single member LLC without the
Yes.
S Corp election yet. Can they make a draw or distribution payment at year end with a lower tax burden on their Schedule C on the 1040 filing?
Make a distribution. When you talk about making a distribution, there is no distribution. As a single member LLC, there is no distribution to be made. As a single member LLC, automatically you are paying taxes on your net income, whether you take the money out or not, or whether you take the money out or you leave it in a business for the business to run yourself. Because the single member LLC, you and your business, you're intertwined. So the business reports a profit on paper, you're going to pay tax on that profit. The only way you can bring down that profit is if you have a retirement, if you contribute into your retirement program. If you have one of these programs, either a simple program, a simple IRA or a traditional IRA, then you can take a deduction to help reduce your taxes. That's the only way, the only thing that will reduce your taxes as a single member LLC.
Thank you so much, and for being so generous with your time today.
Absolutely.
And to everybody whose questions that we were not able to get to, you had great questions, and I'm sorry that we are just limited with time constraints, and we appreciate you attending today. One thing that I would like to recommend is that the PACE SBDC often does some CPA clinics where you can ask some individualized questions of volunteers. I know Orumé has participated in these before. She has been one of the CPAs that volunteer to help answer these individualized questions. So I would recommend that if you are not on the PACE SBDC's email list, make sure that you go get on that so that you're aware when they are going to offer that next to their clients. So a good thing to watch out for, and it can give you a few minutes with a CPA to ask these individualized type questions and get some really good expert information for your particular business.
Yes.
All right. Was there anything you wanted to add to that, Greg?
Yeah, I just wanted to first thank Orumé. You were fantastic. Thank you. A tremendous amount of information, and I can tell that the attendees appreciated it. So thank you very, very much, Orumé. Jenny, thank you for running the show flawlessly as always, and thank you to all the attendees. And again, I would encourage you to please visit the PACE SBDC website. Again, that's pacesbdc.org. We offer a variety of services to small businesses, all free of charge. We'd be happy to try and help. So that's it from me. And again, thank you to everyone.
Thank you,
Yes.
guys. My
Thank you so
pleasure.
much.
See you next time.
All
Cheers.
right.
Have a good
Bye-bye.
evening. Bye-bye.